Right now, it's not the time to be rushing to make quick buck here in the markets. It is a very, very volatile, whipsaw, bunch of chop, very difficult environment to be trading and or even investing. We're getting a lot of false breakouts, false breakdowns, etc. My name is Michael Silva. You're watching the Daily Stock Market Brief. In today's video, we got a lot to talk about because there's a lot of things going on in the market. So I'm going to have timestamps in the description below, but there's going to be very important parts throughout this. So if you can, stick around, watch the video, hit that thumbs up. Let's get into today's show. All right, welcome back. We're going to start off here at the market dashboard and look at a couple charts and then break out into the indices. If you're new here, welcome to the channel. Once again, my name is Michael Silva. I use technical analysis and intermarket analysis to get a good idea as to where the market might go. I do this show Monday through Friday, 5 days a week. Right now, we're looking at the market dashboard. Look at communication services right up there at the top. What did we say on Friday? I wouldn't be surprised to see this as a market leader going into next week. It might end up being the top spot going into the end of the week. I don't really quite know yet, but it was just hammered down the previous week. But we looked at some strength coming in from a relative perspective, and it just made sense that we'd probably see it bounce of some sort. So we got that bounce, and that doesn't mean it's going to stay there, but it's just not surprising to me. What is kind of surprising is to see utilities right there at the top as the market is putting in new highs pretty much, other than, some of the indices. But we had the Dow pressed all-time highs. We had S&P 500. I think we didn't close in an all-time high, but we definitely, I think, tapped the all-time high. I'd have to recheck, but we'll go into those charts here shortly. And then we had a little bit of a down day, and the VIX was up. All right, what was the laggers? Well, financials and energy. So really quick on financials. This right here is the BKX. This is the largest 24 institutions. It's a very important index to kind of monitor and keep an eye on. Now, this red resistance, I've been calling just the red zone. And the only reason why is because interesting things take place when we reach up to this level for some reason. Now, this could be a complete coincidence, but I'm going to call it as I see it. When we ran over here, right, that was the 2008 financial crisis. Then we started quantitative tightening, and that was right up here. Actually, it was for a minute there, and then we rolled over there. Then when we started to recover at that point, the pandemic hit, right it back up at this range again, and then we just took this really big hit to the downside. Then we had unlimited quantitative easing step in. Bam, we just flew vertical right here on a negative divergence, creating an all-time high in this index. And now the month's not over yet, and this is a monthly time frame, but we are creating somewhat of a shooting star type candle. Now, this is important. We're at the red zone. And what just happened? Well, what do you know? As soon as we get into that red zone, we're starting to see hedge funds blow up. This is not a good sign. I mean, we have a lot of cheap money in the systems. Then we get that over leverage. And what happens? Well, when something slightly goes wrong, an unwind takes place. And this could very well be the start of something bigger, or it could just be a one-off. However, I have a hard time believing it's just all a one-off, especially looking at the positions that were sold off in block orders and the banks taking these hits. I could only imagine that some of these other hedge funds are in very similar positions. And I could be completely wrong, so it's all just speculative at this particular moment. Now, what's funny about, it's not even funny, but what's crazy about this specific hedge fund is the person running this hedge fund was a protege of a legendary firm. And surprisingly enough, he was banned for insider trading quite a while ago, and he had to pay a $44 million fine. And I think he was banned for 4 years or so in Hong Kong. I can't really recall, but Bloomberg had a really nice article. If you want to go there, you can go ahead and read that. When I was watching the internals of the market today, we were reaching all-time highs in the S&P 500, and we were doing so with negative divergences on the internals. I'm looking at the NIAD here, so you can see the market getting to an all-time high today right here. I'm on a 1-minute chart, but yet you can see very weak internals taking place. And I'm looking at this now at the close of business. We have the SPX here in this rising wedge on the 1-minute time frame, but it got bid back up within that channel right into close. Now, this is very crazy to me. Okay, what did we see the IWM do? Well, the IWM took the biggest hit of the day out of all the indices, the small caps, and we're kind of still within this technical pattern here. So it's just what takes place if this breaks down. Like we were basically seeing hedge funds blow up at all-time highs, right? We're at all-time highs across the board pretty much, and we're starting to see unwinds take place on not really even aggressive pullback. So what happens if we have a 10%, 15% correction from here? Is there going to be more blood in the water? It's possible, so we need to be just very careful in this environment. This is IWM on the weekly time frame, and then right here is a short-term 15-minute time frame of the INDU and the transports, and I wanted to call this out because Dow Jones hit an all-time high. This is considered Dow theory, and these need to work in unison with each other, and I wanted to call out the divergence here taking place. You have a higher high in the Dow Jones, but it's not being supported by the transports. Now, this is a very short-term divergence, and this can be fixed within an hour, all right? So it's nothing to freak out about at this particular point in time, but it is still worth noting, seeing, the start of potentially a bigger divergence to take place. So if transports continue to fall here, I mean, the Dow Jones Industrials, they need the transports to perform in order for the Dow Jones to perform. So if this keeps falling, or if this breaks down, which if you just draw a trend line from this point to here, it's the start of a potential breakdown even further. Now, it might only be down to around 14,250, but that would suggest weakness in the Dow Jones Industrials as well. Now, I've been talking about the seasonality chart going into April, right? Seasonality of April, we really typically get some big rips in April, and that's still a possibility, but we haven't seen really a sell-off. I mean, we have in some indices, right? But nothing's really screaming out, okay, buy here. And we'll see that in the indicators that I'm going to be going over, and also the chart patterns that we're going to be looking at. But I wanted to look through history. Okay, so what were some years that maybe April didn't perform? And you didn't need to go back too far, but 2011 right here, we saw a 2.8% dip into April. And then the next year right after that, in 2012, you saw almost a 5% correction, or 5% dip right into April as well. Now, these ended up getting bought right back up for the most part in more of mid-April. So we got to stay on our toes. Maybe the beginning of April might not be that great, but if we start pulling into some areas of support, it could present a good potential opportunity to go long. So just a lot of different things taking place right now. Pay attention to this hedge fund blow up, because that could be the start of something bigger. We do not know yet. It could be nothing, but you see Credit Suisse take a 15% drawdown in a single day. That's not a small amount. So we got to be very, very careful, because we don't know what other banks are going to follow suit. And, like I said, we're at the red zone right here in the banks. And if this takes a big hit, well, I mean, the IWM, 20% of it is financials. So if the financial market gets hit, it's going to bring down some of these indices, because the banks, they hold a lot of weight in the equities and equity markets. Now let's look at some indices. We're going to look at S&P 500 first. I wanted to just call out the possibility of a double top right here in the S&P 500, but if we get above this previous high of the day and see a lot of strength, I think it could easily shoot to 4,000 to 4,100. We called that out originally on this descending megaphone pattern. Then we called the bull flag breakout. So, there's still, it's in bullish context. We had the 20 period sloping up 50, 200, but there's always the slight possibility here that could be a double top. So just be mindful of that. We'll see what futures bring, and then going into tomorrow. 30-minute time frame, I just wanted to call out we have a slight divergence here, and it could be potentially a rising wedge pattern. If we broke down, could easily take us to around 387 to 388, or potentially retest this bottom right here at 384. And you can see right here, there's clear resistance right at around 397. All right, so let's go to the Dow Jones now. Dow Jones, we have this megaphone descending or ascending, broadening wedge pattern, all-time high close, bullish context overall, bull flag potential breakout right here. Everything points to higher highs right now. As you can see, we're making a higher high and also higher lows. So just take note that, sometimes what forms are these, not morning stars, but evening star reversal type patterns. So if we have a big green candle up to the upside, then we have this kind of, not really a doji, just a small body, small range candle indicating that potentially momentum is slowing. And if it's followed through by a big red candle to the downside, and it closes on the low at 32,750 or something like that, that could be one of those evening star reversals, and we potentially see it head a little bit lower. But overall, like I said, bullish context, and we don't know how tomorrow is going to end up. If we get this big gap up tomorrow, that might be an opportunity to sell into that strength, because we are running into this area of resistance right up here, excuse me. All right, and then we have the 30-minute DIA Also, rising bull channel or potentially rising wedge right here. We got a little bit overbought. We're pulling down just a little bit. If we do break out of that, I think it would easily come test right around 327.50 to 327, right around the 200 to 50 period moving average, or potentially see how this was resistance right here. Then we gapped above and we ripped. That was on previous market breeds. That's right around, like I said, 327.50. So that would be the target on a breakdown to the downside. Then you could potentially play it as a good risk versus reward trade. But, you know, we got to just see what it looks like going into tomorrow. Now let's look at the Russell. Russell took the biggest hit, down 2.81% today. All right, we still have this area of support right around 210, so let's keep an eye out for that. We're well below the 50 now. We're back below the 20 as well, so this could be a potential dead cat bounce. But like I said, we haven't broke this neckline right here, and this little area of support, if it breaks and gives way, I mean, there's really nothing holding us up to 190 and potentially even lower other than this 200 period moving average. And like we've been saying, structurally speaking, all these gaps to the upside aren't the greatest look. And, you know, a lot of the times we get gaps that are filled. And if you go back through history, I think I read something about, you know, 80+% of all gaps get typically filled. So, I mean, we're living in a new world. You know, there's no guarantees, but that's just some poor structure right here, being the market moving significantly higher, but it's really based off of a lot of overnight sessions. So let's keep an eye out for the breakdown of that potential support line. Then on the 30-minute time frame, 221 is that area of resistance. If we break above that, I think the next area would be right around 324 to fill this gap. So that'd be to the upside. As far as the downside potential, this is a bear flag. If the bear flag breaks down, I think it goes and tests 208, which could be potentially be a bottom, another bottom, and another bottom, resulting in a triple bottom. So that could act as an area of support. But if it breaks down and puts down a lower high and then breaks down through that area, that could spell out a lot of weakness too as well. And one has to wonder, if we get back down to these levels and break down, what that weekly time frame is going to be looking like. It's going to be looking pretty bearish. Now let's look at the Nasdaq. The Nasdaq broke down through this potential bear flag. This could be potentially a hanging man type candle. We pulled back pretty significantly today, but then got bid back up right by the 20 period moving average. And we haven't recaptured the 50 period moving average either. So, you know, we bouncing from this level of support. We came back. We've been riding this channel right here. As you can see, we need to get back within the channel, and we really need to recapture 325 to show any signs of strength. And I mean, if I draw a line from here to here, this might be potentially, you know, act as somewhat of a trend line too as well. And that could eventually, you know, put in higher lows, and then we break through in April. We might see a screaming April, but we're not there yet. So, you know, we got to watch it, how it unfolds every day. Then on the Qs here, on the 30-minute time frame, I just want to call out the potential for this bear flag. If we do break down through that, easy target would be to come fill this gap right at around 300. So keep that in mind. Let's look at the indicators. Indicators, I wanted to call out the percent of stocks above the 200-day moving average. I mean, you don't typically want to go long at these points. It's at a very, very high spike at 94.39. And, you know, it could very well go higher, but why? It's just not the greatest spot, in my opinion. When we get these huge spikes to the upside, contrarian point of view would suggest that, okay, you want to wait for somewhat of a pullback, because when we do get to these levels, we've seen significant pullbacks, you know, not like crazy ones, but we have seen some pretty, you know, 3%, 5%. I've seen an 8% move when you get these spikes to the upside, and that's a very, very high reading right there. The NI high low, the NYSE high low index, also down. As you can see, you know, we're slightly up here. So this has just been moving down. We've been moving up right here. So a little bit of a negative divergence taking place there. Here is the NYMO. We use this as a breadth indicator, and it's still holding that negative divergence. We were down minus 21.78, which is interesting because now we're hitting all-time highs in the S&P 500, and we're doing so with, you know, weak internals, negative breadth, and negative on the NIAD too as well. So just overall, just weird market. Another thing I want to call out here is the NIM exposure. It might not be updated, but just take note that we're not super excessive above 100, where we're using like maxed out leverage. So we're back down here right around 60. The week isn't closed yet, so this might not be fully updated. So who knows where that's going to finish going into the end of the week. Then we got the VIX. The VIX is broken out of this falling wedge, which could indicate a potential rise here soon of volatility. That's a bullish breakout, and you can see the RSI kind of cupping itself, still below 40. Below 50 at this particular point in time. We've seen that before where it cups and then we get this little spike. We've seen it cup and then we got a spike. So let's keep that as a possibility. Now, another thing that I want to call out is the rate of change, the 4-week rate of change from XLU over SPY. This is part of the beta rotation strategy from Michael Gayed's white paper, award-winning white paper. Last week it told us, okay, it's a risk-off environment for this specific strategy, and we're still way clear above zero, and utilities keeps continuing to kind of outperform the SPY as of right now. We don't know what's going to be taking place towards the end of the week, but keep in mind, this doesn't say like, okay, the market's going to crash by any means. I mean, hasn't predicted that, but it's called out pretty much all the big market crashes by when it was flipped back to zero. But it does foreshadow the potential for increased volatility to come in the near future. It says the conditions are ready for the possibility for something bad to take place. And, this could be just an early indicator of something potentially bigger that we might not know take place. Now, not a guarantee and not to scare anybody out of positions or anything like that, but it's, like I said, worth noting and being aware of, because you don't want to be just caught blindsided in this environment and be like, what just happened? All right, let's get into commodities. Gold, weak looking. However, the only maybe positive sign is this could be a little, bump up and then bull flag right here. It's not the strongest conviction that I have, especially seeing down 17 on the day, down percent, and the dollar's getting some strength here. Silver, on the other hand, we called out this falling wedge. That's bullish, and it's in bullish context. We're sitting right around the 200-day period moving average. I'd love to see silver break out, but I'm not fully convinced that it's going to be breaking out, just given this context of, a high, a lower high, a lower high, and it's putting in lower lows. It's just seeming to get weaker and weaker and weaker. But, we are still within a longer term period of consolidation. So we'll keep an eye on it. It could present a good speculative buy right down here, and then we see it rip higher. We did call out this pull and then this bear pennant pattern right there, and it did break down to this. But we did say that it could potentially head a little bit lower too as well. So we'll see. We'll see how this plays out. Bitcoin, still holding at this area of resistance right here. It did pull down into this area of support, came down a little bit, did not get below the 50-period moving average. It held as an area of support, and now we're coming right back up. So a breakout of this could be a very, very good sign for Bitcoin, but just take note, which it might not be worth anything now, but you have a negative divergence here. You have a negative divergence here on the price percent oscillator. On the weekly time frame, I don't have that chart up, but that's a pretty gnarly, also negative divergence. So don't be shocked if we do see some sort of breakdown, and who knows what takes place when you see a market unwind. We don't know what can come from this hedge fund being blown up. This could be the start of something, bigger perhaps. And the amount of leverage that they were using is just astonishing. But the amount of leverage that all these hedge funds are using at this particular point in time are even more than what it was in 2008. And you can think, just easy financing, cheap money, and who's going to take it on the chin with all this? Well, the hedge funds, the banks, and then the everyday person, unfortunately, if something bigger does happen. So just be careful. You got to be very careful in this environment. It's not the greatest environment to be trading in, to be quite honest, or investing in. It's just a rough time, even though it's a super strong bull market. It is what it is. Crude oil did finish up on the day. This could have resulted in a just nice big, it was pretty bearish, but then we got this bounce from the 50-period moving average. Could be the result of freeing up the cargo container there on the Suez Canal. I think I'm pronouncing that correct. I believe it's almost taken care of now from what I read, but we're still within potentially a bear flag pattern, so take note of that. 50-period is holding up still, and the context is still bullish. We've got to get above 62. Get a break above that, we'd easily tag 64. If we get above that, we could very well take out the previous high, continue to scream higher. But as it stands right now, we're just within this little channel pattern. Now let's look at the dollar. The dollar bull flag breakout, showing signs of strength still, continued strength. And that's scary for equity markets, especially when we see like the how much of a mirror they interact with one another. So you can see the high here, a lower high, and a lower high, and you see the S&P 500 stair-stepping up. So when this is breaking out and you're not seeing the S&P 500 mirror anymore, you just got to be mindful of that. Like, is this all of a sudden different? I don't think so. I think that if this continues this forceful move to the upside, and reaches up to 95, 96, I think the equity market is going to really struggle with a dollar that's just ramping up higher and higher. And we're seeing this actually in the markets. You can see it with CHOP, but there's just all these different elements also, just underlying elements that are just making this a very difficult environment to be in. Let's go to bonds and yields. Yields first, 30-year up, 10-year up. What do you know? Are we that surprised? This could very well just been a pullback to, how does trends work? Well, you put in a high and then you drop down and you put in a higher low, and then you move right back up. You put in a higher high, you drop back down, you put in a higher low, and that's what it's been doing. It's been pushing higher and higher. But at what point is the Fed going to do something about it? Is it going to be at a 10-year at 2.0? Maybe. Is it going to be at 1.9? I don't know, but you can see the markets aren't responding all too well with these yields pressing higher, especially these small caps as yields continue to rise. And then we're looking at the bond, the TLH. You can look at the TLH or the TLT, but we called out that bullish divergence. We've seen it pop right there. Now we're sinking down a little bit, but it's still holding its bullish divergence. If this even creates a new low, we still might actually have a bullish divergence there, which could result even in a stronger ramp up. So still within a support zone. And we said this, like I feel like it was getting super oversold. So we'd probably bounce around right here for a little while and kind of maintain. All right, everybody, it's kind of just wrap everything together. Once again, just to clarify my thoughts, look at from a seasonality perspective, we typically see rips into April. But before you just get super excited and kind of push to go all in, just take note of 2011. We saw the drawdown. 2012, April, we saw that drawdown too as well. I repeat, do not be in a rush to make money in these environments, because if you're in a rush, chances are, you can get caught up pretty easily. You could get very lucky too as well, but this is a long-term game. You need to be very diligent, tactical in this environment. Yeah, it's not easy for anybody. Even the pros keep on talking about just how difficult of an environment like this is. The hedge fund that is blowing up, right? Read an article about it, learn a little bit about it, but just be mindful that that's actually a big deal and it could lead to a bigger deal. It might not lead to anything, right? It might not, but it might. And just because there's a possibility that there could be more pain in the banks, you just need to be super careful. I don't know how else to say it. I say it often. We've been getting all-time highs on these weak internals, okay? You see the NIAD. I just went over the NIMO. We're seeing extensions on the 200-day moving average, big spikes that we haven't seen for quite some time. But yet when you look at these daily time frames, it's like no one cares. Like all these dips are just getting bought right back up, okay? So very well might just see continued pushes and higher. Markets can stay like this for a very long time, but you just need to have in the back of your head, be bullish, but you can be cautious. And if you're cautious, you might rethink about, if you're entering into a trade or investment, like, should I be putting that big of a position size into one equity, right? Or should I be even buying on this specific dip if it's, the area of support is $15 below where I'm entering right now? You need to take these things into consideration and focus on the management of risk. Because you can see right now, if hedge funds are blowing up, guess what they're not focused on? They're not focusing on risk. They're in this rush to liquidate, right? You don't want to be caught up like that. You personally wouldn't want to be caught up in a position where you're getting, you're liquidating out positions, or heaven forbid, getting margin calls on short positions. That'd be just a complete wreck. So yeah, that's all I got for you on today's episode, everybody. Have a nice night, and I'll see you back tomorrow.